How's it going, everybody? My name is Thomas, and this is For the Common, a new investment channel that is focused on true investing. Now, if you missed the first video that I posted a little bit ago, that is a highlight of what we're hoping to accomplish with this channel, For the Common. Outlines the mission, and it's really a focus on you, an investor, and arming you with the information and the tools that you need to be successful over the long term. So if you're new to investing, got good news for you. It can definitely help you there. But for now, my plan is to just give a quick brief overview, and then down the road, I'll include a little bit more color in probably another video highlighting, what is the stock market, what are stocks, and how does that all interact, and the kind of day-to-day moves that you see. So ultimately, that'll be coming down the road. But in short, stocks are a small piece of ownership of companies, which is really amazing when you think about it. You can go out in a stock market, on your phone and buy ownership in a stake in, Apple or Google. Pretty remarkable. And that's something, once you own it, you ultimately benefit from any sort of value that the company creates over the long term. And they're really, really powerful, and ultimately some of the best compounding vehicles that I've ever seen for growing your money over the long term. So do you want to know what that portfolio manager taught me, who manages a $50 billion, yes, billion with a B, $1 billion strategy, what he taught me? Yeah, or if you're just looking to invest like a pro, I can help you with that. Over the last decade I've spent in the investment management industry, my focus has been looking at and working at investment management companies and really analyzing the way professionals invest. Several years ago, my sole job was to interview portfolio managers at some of the largest investment management firms and managing some of the largest investment strategies in the US, and just ask them any question I wanted. It could be about their investment strategy. It could be about them personally. It was an amazing role, and it taught me so much about investing as a pro. Something else that taught me is that there are a million different ways to invest. It's really incredible. If you're looking on YouTube, there are things like day trading, swing trading. That's a little bit more in the gamble part, but is exciting, so I can understand interest in it. There's also value versus growth. There's small cap, versus large cap, and investing in different sizes of companies. And then if you look at the hedge fund space, there are things like convertible arbitrage. Interesting. There are things like long-short pair trades, global macro event strategies. There are things like merger arb. There are so many different ways to invest, but it's kind of hard to figure out exactly how you and me as an individual investor can take those investment strategies and really implement them in our lives. A lot of the quick trading strategies, or even those hedge fund strategies, need a lot of resources, computer programming and PhDs in math to really execute. And for us, it's probably not feasible. So with so many different investment strategies out there that you can try, how do you figure out what works? Well, for me, over time, I tried a lot of them. And I also interviewed portfolio managers over my time in that job, really to try and identify what worked, what didn't. Also, what made sense to me. That's one of the most crucial components. For as things get volatile, you have to be able to really rely on something that's logical to you, but also what doesn't require a ton of effort. And ultimately, I applied those investment strategies in my own personal portfolio over the years, and I made a ton of mistakes, but that is okay. That's investing. That's how you ultimately learn. And after years of trial and error, and then ultimately trial and success, I'm here to share you a few pointers that I think will really help you in your investment game. So these tips for me as an investor have become principles that I live by. And I think they're really important for you to take a look at too, and try and internalize in your investment story. And I'm calling them Thomas takeaways because it seems to make sense. So, takeaway number one is that investing is incredibly humbling. It's a really challenging thing to be good at, and you're going to get a lot wrong over time. But don't worry, that's okay. The best portfolio managers out there generally get about, and this is the best, 60 to 65% of their calls right over time. That means 40% of it and their work is wrong. The decent ones are about 55% of the time. So what that means for you is that there are going to be a lot of mistakes along the way. But again, that's really important for you as an individual investor to learn from those mistakes and get better for next time. So that's the journey of investing. And again, Thomas takeaway number one, it's a humbling game. So the next Thomas takeaway that I want to highlight is an interesting one, which is ultimately that everybody is going to be right eventually. Now, they might not be right exactly on the numbers, but they're going to be right on the direction. So let me explain. If somebody thinks that a stock's going to go down 50% or 60% over the next however long, yeah, they're probably going to be right eventually. Most stocks, even the best ones over their life, go down somewhere in the ballpark of 50 or 60%. Just for whatever reason, they fall. So that person's right. If you're a person that thinks that same stock's going to go up 100% or maybe 200% over a certain amount of time, yeah, you probably eventually be right. There are a lot of really great companies out there that are compounding and result in great stock performance. If you think the economy is going into a recession, you're eventually going to be right. There will eventually be another recession in the future. If you think the economy is doing really well and it's going to continue to do really well into the future, yeah, you're probably eventually going to be right. I assume you're getting my drift here, but ultimately it becomes really challenging because the market is filled with a lot of different opinions, and it's going to take years for it to play out. But ultimately, these swings can happen all the time as people are trying to digest information and put their view out in an investment strategy. So, how are you supposed to try and invest when you have all these different cross currents and the market's just going in all sorts of directions? Well, meet my friend, Mr. Market. Mr. Market is a psychopath who has severe mood swings. Great friend of mine. Yeah, well, that's how Ben Graham, often considered the father of value investing, tried to describe the market in one of his books, Intelligent Investor, and really coined this character named Mr. Market, who again is a little bit of a volatile character. So if you think one morning Mr. Market wakes up, sunny outside, optimistic, has a nice cup of coffee, thinks the economy's doing well, and ultimately is going to go out and buy every stock that Mr. Market can get his hands on, no matter what the price is, just can't get enough. But, the next day, Mr. Market wakes up, it's cloudy, he's depressed, the coffee's not as good as yesterday, and he's worried about inflation. So he's going to go sell all those same stocks that he just bought now at a much lower price because he's worried. Now, sometimes that can happen from day in and day out, but sometimes these mood swings from Mr. Market too can last as long as a week, sometimes years. And that's the hard part about investing. When you have these frantic moves from Mr. Market, it's really difficult to explain. So if you're confused by the stock market, don't worry. Half of us investors are confused by the daily moves in the stock market. It's actually pretty fun to watch CNBC or Bloomberg try and explain what's going on in the market from day in, day out. Oftentimes they make something up because a lot of times we don't know what moves the market, and occasionally Mr. Market's just in a bad mood. So you're working with a maniac. You got a million different ways that you could try and invest. And your odds of success are about 50%. Yeah, sounds like a great time. Sign me up for the stock market. Cannot wait. Yeah, so how are you supposed to win in that type of environment? Well, here's the secret that portfolio manager taught me so many years ago. Generally, investors overestimate or they overemphasize the downside of a specific investment. At the same time, they underestimate the upside or the potential of an investment because the future is so hard to predict. Let me explain this a little bit more with a story that really solidified the concept for me. A few years ago, as part of my job, I went to go interview a portfolio manager in this big, beautiful metro, and all my expenses were paid, flight, hotel, black car to their skyscraper downtown. It was really, awesome experience. And you get to this super modern building, you go to the top floor, and elevator opens up, and it is just an incredible office, just so nice, pretty much all glass. You could see this incredible view, and of course they show you the incredible view, of the water, of the harbor, boats. It was really stunning. But at the time, it was pretty par for the course. A lot of investment managers have nice offices because those companies make a lot of money, and as well, they have to impress clients. And I was focused on giving the portfolio manager that I was about to see a little bit of a hard time because he owed me. So we ended up going to this conference room, with this massive table, maybe 12 people could sit at it. It was huge. Just me and the sales contact were chatting. 5 minutes go by, and this individual walks in. It's the portfolio manager. So it's about 5'10", average height, average build, nothing necessarily remarkable. But this particular portfolio manager had about 30 years of investment experience. So seasoned individual. He has an Ivy League education, went to the best schools, wore glasses, so looked very smart, and rightfully so. This portfolio manager managed about 50 billion with a B, $50 billion on behalf of clients in this mutual fund. So for somebody who manages about $50 billion with 30 years of experience, you're going to be paid quite a bit. So if I had to take a guess, it's a rough ballpark, but he probably made in the realm of 10, 15, $20 million a year. That's my guess. And I've heard, things over the years, so that's probably pretty close. Probably made more. But ultimately a very well-polished individual for somebody obviously making that much. So all this generally used to make me nervous sitting across from the table from such an impressive person, but this individual actually owed me. And the reason why was because his strategy was underperforming peers, and I was having to then go back to my clients and tell them why they should keep conviction in this particular manager. And so I needed answers from him around what he was going to do to try and improve performance and exactly, explain why he was underperforming. So had all my report cards ready, papers shuffled, and we dove straight into tough questions. And I drilled him on exactly what his team had gotten wrong around the macro environment, around different company calls that they had made, and really the market and why it wasn't favoring his style. And we eventually got in kind of the deeper list of companies around what had underperformed for their strategy, and that is when the magic moment happened. So I turned to another company, and I'm going to leave the name out for now just to create some suspense, see if you can guess it. But I start asking about this low profitability. I ask about a really high valuation, some recent controversies that have caused the stock to underperform. And he looks at me, leans in, says, "Son," and I don't think he really said son, but he might have. My memory makes it seem like he said son because that was definitely his tone. Like I said, he wasn't very happy with me, but he continued. I was pretty early on in my career when I took a risk on that company, and it was definitely a risk. There was not a clear path to profitability. There wasn't, a proven business model. It was a really high valuation, and there was kind of a crazy founder at the helm. But at the same time, I saw a lot of interesting potential in a new business that I thought could grow really quickly. And it was growing very fast from a revenue standpoint. So I decided to take a shot on this online bookstore. He also shared that the stock was recently down 80%, 80, okay? Seems like a good time to buy maybe. So he invested, he told me that he invested a lot at $15, bought a ton of shares for his investors. And the stock then proceeded to fall another 60% from that $15 price, so down to $6. Not a great move for a brand new individual in their investment career, but he held on, he had conviction in the company, and ultimately, the company ended up to where it is today. So then he asked me, looked me dead in the eye and said, Do you want to know how much money I've made for our investors in that stock over the last several years? That's what we're trying to do here. Boom, mind blown. What? Oh my gosh, that's crazy. If you don't know what stock that I'm talking about Amazon, the online bookstore, right? That's what it started as. And this individual bought a bunch of shares at $15 back in 2001. Remember, that stock then fell another 60% from where he bought it. Ouch. But over the long term, that stock went from 15 to 3,000. It trades around 3,000 today. So that original investment of $15 to 3,000, that's about a 20,000% return. 20,000. And he made about 200 times his original investment on that Amazon trade. Wild. So if you invested $5,000 in Amazon at $15, today it would be worth around $1 million. 5,000 to $1 million. That's incredible. So get this. I followed up asking the portfolio manager how his team knew that Amazon was going to be the winner in e-commerce, or how did he know that Amazon Web Services was going to grow to be this technology cloud juggernaut within Amazon. And he looked at me and said, yeah, we didn't know. We got lucky. But what we did do is find a company with great potential, an excellent leadership team, and good business fundamentals. And the company invested aggressively, it innovated aggressively, and it won. And as shareholders, because Amazon won, we won. Wow. So what's the moral of the portfolio manager's story? Well, remember back to my question. It was focused on the short term. It was focused on some recent noise that caused Amazon's price, for whatever reason, to trade below where it was a couple months ago. Could have been the fact that Amazon was up more than 100% over a couple of years. So who knows? But ultimately, what the portfolio manager was trying to say, and what clicked for me then, was that you really need to focus on a company for the long term and dial in on things that are important to the underlying business. So I did something I promised I would never do, and I caved, just as a value-oriented investor at the time, went against all that, and I bought Amazon. It was an experiment. Everybody was worried about slowing growth, competition, about low profitability, about high valuation. Now, that was ultimately years ago, and I bought it at right around $1,000. And now that it trades at $3,000, it's a 200% return in a couple years in a stock, which is not bad. I think the portfolio manager was onto something. So let me reiterate the secret that the portfolio manager taught me that day. It's that investors overestimate and overconcentrate on the negatives of today and the here and now because it's present and it's top of mind. However, investors also are really bad at predicting the future, especially when it comes down to understanding the full scale of a business's potential. So, did this massive analyst team and the portfolio manager know confidently that Amazon was going to be the next trillion-dollar company? Absolutely not. But the key that they did know is that the maximum that you can lose investing in a stock when you buy it outright is 100% is what you invested. So this portfolio manager, when they bought at $15, that could have gone to zero. It almost did. It went from 15 down to 6. But the important thing is that the investment team knew the other side of the trade, the potential, and that while you can lose 100% of your investment, your upside, or what you can make, is actually uncapped. It's unlimited. And so as a result, this team had the conviction to hold the company through the volatility, and they were rewarded. And really great businesses over the long term can produce absolutely incredible results. So you may be thinking, portfolio manager got lucky on his timing, or look, you picked Amazon. Good luck doing that again. You could think that, but honestly, I'd argue you're wrong. If you look at the timing component, if the portfolio manager, instead of buying at 15, bought at the worst possible time, which would have been $100 at the 1999 peak of the dot-com bubble, Amazon would then fall from 100 to 15 to 6. Brutal, right? Ouch. Could you imagine living through that? But then over the years, as the company generated value, it rebounded from $6 to 100. Hey, made your money back. But in addition to that, it went from 100 to 3,000. It's pretty good. Now, if you look at that return from 100 to 3,000, that's about a 3,000% return, a little bit less, which, over time, I feel like 3,000% is pretty solid. Now, again, you might be thinking, well, it's Amazon, right? There aren't other companies that do that. We both know that's not true. We talked about it in our last video that there have been amazing businesses out there that have changed our lives as consumers and ultimately changed the lives of their shareholders. So you think about Apple, right? How about Tesla, Microsoft, Nike, Costco, Home Depot? The list goes on and on. These are amazing businesses that have generated billions of dollars for their long-term shareholders over time. And yes, at some point, crazy Mr. Market came up and said, this stock should be trading for substantially less, and the stock got really hit. But those people who stuck with it, invested for the long term, they were able to participate in the long-term compounding potential as these companies grew revenue, created value, and beat competitors. And as a result, shareholders became rich. So that conversation with the portfolio manager, it really got me thinking. Why can't everyday investors like you and me take that exact same approach and then benefit from the long-term value creation and compounding of amazing companies? It's not really a secret strategy. Warren Buffett has famously said that his favorite amount of time to hold a stock is forever. So great. All you got to do is buy a stock and never sell it. But in practice, that's really hard to do. And the reason why is the reasons we already talked about. Investors will tend to focus on the short-term uncertainty, fear, lack of ability to predict the future, and that'll cause them to do some pretty crazy things, usually because they're scared. But that creates opportunity, and that opportunity is how we can win. So as opposed to being a trader focused on short-term, ownership of a company, we can look for companies that we believe have really significant potential, that have good fundamentals, and we can own them for the long term, like a business owner would versus a trader. So great, you might be thinking, all we have to do is pick a random stock and own it long enough, and then we'll be good. Unfortunately, that doesn't work either. And to unpack another Thomas takeaway here, this comes from the father of value investing we already talked about, Ben Graham. He describes the market like this. In the short term, it's a voting machine, where it clearly shows what's unpopular and popular. And then over the long term, instead of being a voting machine, the market is a weighing machine. So it actually judges the substance of a company. So what does that mean, voting versus weighing? It's saying that in the short term, Mr. Market can do some crazy things. But in the long term, a stock will ultimately follow the fundamentals of the underlying business. That's how we win. So, how do you then go out and find those great businesses with awesome fundamentals that you want to own for the long term, or that are poised for amazing success? I think it can help you with that too. Having talked to a lot of portfolio managers over the years across a ton of different strategies, they generally look for the same thing when it comes to identifying a quality business. And a lot of those characteristics, they make sense, they're logical, and I think they'll make sense to you too. So the goal of the next video will be to break that down, to provide some examples, and hopefully show you how you can pick stocks and ultimately pick companies like a pro. Hope to see you there.